If you're an Australian retiree with money sitting in an ordinary bank savings account, there's a real chance Centrelink is currently assessing you as if that money is earning far more than it actually is, and at the exact same time, your bank is quietly paying you next to nothing on it. That combination is costing retirees real money right now, in 2026, and almost nobody has actually sat down and worked out the gap. Today, I'm going to show you exactly why this is happening, what changed very recently that makes it worse, and what to actually do about the money sitting in your own accounts. Stay to the end, because the fix here isn't complicated. It just requires you to actually look at two numbers side by side, something almost nobody does. Before we get into it, if you're not subscribed, do that now, because these rates get reviewed and reset periodically, and if you're not across the current numbers, you can end up making decisions based on old information that no longer applies. Let's start with the foundation, because this is the part most retirees never have properly explained to them. Centrelink does not look at what your bank accounts, term deposits, or investments actually earn you. Instead, it uses something called deeming. Rather than tracking every single interest payment or dividend across every account you hold, Services Australia simply assumes your financial assets are earning a set, standard rate of return, and that assumed figure, not your real interest, is what gets counted as income for your age pension. Here's exactly how it works right now. As of the 20th of March 2026, the first tier of your financial assets is deemed to earn 1.25%. For a single person, that lower rate applies to the first $64,200 of your financial assets. For a couple, it applies to the first $106,200 combined. Anything above that threshold is deemed to earn a much higher rate, 3.25%, regardless of what it's actually sitting in or what it's actually earning you. Now here's the part that matters most for this video. These rates aren't small technical numbers that never move. They were recently increased. For years, during a period of very low interest rates, deeming rates were frozen at record lows, 0.25% on the lower tier and 2.25% on the upper tier. As interest rates in the broader economy rose, the government began resetting deeming rates upward to reflect that. They went from 0.75% to 1.25% on the lower tier, and from 2.75% up to 3.25% on the upper tier, both as of that March 2026 date. That's a real meaningful jump, and it directly affects how much income Centrelink assumes you're earning from your savings, whether you're actually earning that much or not. Here's the mechanism that makes this genuinely important to understand, and it's exactly the reason for the title of this video. Deeming works exactly the same whether your money is earning nothing in a basic transaction account or working hard in a properly chosen high-interest savings account or term deposit. If your investments earn more than the deemed rate, you simply keep the extra. It doesn't count against you and doesn't reduce your pension. But if they earn less than the deemed rate, and this is the crucial part, there is no rebate, no adjustment, and no sympathy built into the system. Centrelink still assesses you as if you're earning the deemed amount, even if the real number sitting in your bank statement is a fraction of that. Think about what that actually means if your money is sitting in an everyday, ordinary transaction or savings account at your regular bank, the kind that pays a bare minimum rate of interest, sometimes barely above zero, especially once any short-term promotional bonus rate rolls off. You are being assessed by Centrelink as if that money is earning 1.25% or 3.25% above the threshold, while your actual bank statement might be showing a fraction of a percent in real interest paid to you. You are carrying all of the downside of deeming, a lower pension because of assumed income, while receiving almost none of the upside because your money isn't actually working anywhere near as hard as Centrelink assumes it is. This is the exact gap that matters, and it's been getting wider, not smaller, as rates reset. As one retirement commentary put it plainly, if your investments are earning around 1%, but you're being deemed at 3.25%, Centrelink is counting more income against you than you're actually receiving. For a retired couple sitting on around $400,000 in financial assets, moving through this recent deeming increase alone can mean Centrelink assessing roughly an extra $2,000 a year in income under the test, whether that couple's money is actually earning that or not. So here's the practical reality this creates. If your money is sitting in a low-interest, basic savings or transaction account, you are effectively taking the worst of both worlds: a reduced pension based on assumed income and low real returns that don't come close to matching what's being assumed. The fix isn't to try to argue with Centrelink about the deeming rate. That's simply not how the system works. You can't ask for a lower deemed rate just because your account happens to pay less. The fix is to make sure the real interest you're earning is at least closer to, or ideally above, the rate you're already being deemed at, since you're being assessed at that level, regardless of whether you're actually receiving it. This is where the actual action step comes in. Go through every bank account, term deposit, and cash holding you have right now and check the actual interest rate each one is currently paying you, not what it advertised when you opened it, what it's paying today. A lot of accounts advertise an attractive rate for new customers or for a limited introductory period, and then quietly drop to a much lower ongoing rate once that period ends, and plenty of retirees have money sitting in exactly that kind of account without realizing the promotional period expired years ago. Compare that real current rate against the 1.25% and 3.25% deeming thresholds we just covered. If your money is earning meaningfully less than what you're being deemed to earn, that gap is money you're effectively losing twice over, once in real foregone interest and once in reduced pension payments based on income you're not even receiving. From there, the practical options worth exploring, and I want to be careful here because this depends entirely on your own risk, comfort, and circumstances, are simply making sure your cash is sitting in accounts that are genuinely competitive right now, rather than accounts you set up years ago and never revisited. That might mean a properly compared high-interest savings account or a term deposit locked in at a rate that reflects current conditions rather than conditions from several years ago. None of this is about chasing risk or moving into anything complicated. It's about making sure ordinary cash sitting in the bank is earning what ordinary cash can reasonably earn today, given that Centrelink is already assuming it's earning close to that anyway. I also want to flag something important so this doesn't feel like one-sided bad news. Deeming genuinely can work in your favor too. If your money is earning more than the deemed rate, perhaps in a well-chosen term, deposit, or a competitive savings account, you keep every extra dollar above the deemed amount without it counting against your pension at all. That's the flip side of the exact same rule that can hurt you when your money is underperforming, so getting your account sorted isn't just about avoiding a penalty, it's about potentially coming out ahead of what Centrelink assumes. So here's what I'd actually do this week. Pull up every bank account and term deposit you currently hold and write down the real interest rate each one is paying you right now. Compare that list against the current deeming thresholds, 1.25% up to the threshold for your situation and 3.25% above it. Anywhere you find a meaningful gap, money sitting well below what you're already being deemed to earn, that's the account worth actively reviewing and potentially moving, rather than leaving it exactly where it's always been out of habit. Because everyone's total asset position, pension situation, and risk comfort is different, the right specific accounts and terms for your own money are genuinely a conversation worth having with a licensed financial advisor, or through the free financial information service available through Services Australia, which you can access by calling 132-300. They can help you understand how any changes to where your money sits would actually interact with your specific pension assessment. I want to be upfront about what this video is. It's general information based on current published Centrelink deeming rules, not personal financial advice. Whether moving your money makes sense for you depends on your own full financial picture, and that's a conversation for a licensed financial advisor or the Financial Information Service. If this helped you see a gap in your own accounts you hadn't noticed before, subscribe for more of these breakdowns and share it with another retiree in your life who might be sitting on savings earning far less than Centrelink already assumes they're earning.